Hey, good afternoon once again, Market Rebels and Stu.
Yeah.
Pretty big turnaround. I didn't see the actual close, but I think during Q&A we were up just a quarter percent, 0.3. How did we close today?
Up 1.3%. The market pretty much rallied throughout the afternoon.
Wow. That's a good rally.
Yeah, it was a nice rally. Got back a lot of yesterday's, and the Qs were rallying during the day as well. So nice day.
Yep. And then I think we have Meta earnings after should be coming out. If you happen to see those, let us know.
Yeah, okay.
We saw that big UOA trade in there with what was it?
100 million or something?
$100 million in there. Crazy.
Is that a lot? So anyway, Bill?
It says Stu size trade. So it'll be interesting to see. But hopefully, if we get some of these bellwethers to come in with some really good earnings, that could be a little more fuel to propel this market even higher. So let's take a look at today's Coach's Corner. So again, we want to welcome everybody here. If you're brand new, it's great having you here. One of the things that we like to try and show on Coach's Corner is things that are more facts about options. And this is a way that the inner mechanics work about options. We talk a lot about pricing and strategies and things that most people just never consider or have never possibly even heard of. And we like to start off with a little brain teaser question here, what we call Chalk Talk, which we will answer at the end of this presentation. But here we go for today. Ready for this one, Stu?
Go for it, my friend.
All right. So we've got the, now this was just shot recently, the SPX, S&P 500 index 90-day 48.90 call trading for about 145. We also have the AMD 90-day call 170 strike trading for 15. These are both at the money options. And the question is, which has more leverage? Now, I should also add a little footnote here. Some of you might be following along and saying, hey, wait a minute, there's no 90-day option on AMD or even SPX for them. SPX is very close, but AMD was within about 10 or 12 days. So what I did is I just put it into a pricing model to kind of interpolate where they are. But it's not so much the exact prices that are important. It's the concept, and you're certainly free to do your own examples once we end up finishing this presentation. So Stu, how do you think most people are going to answer this one? I know you get this question a lot as a coach.
The SPX versus the AMD.
Yeah.
I'm going to say most people are going to go with the AMD.
Yeah, I think they would too, because it's a tech stock. They typically have higher volatility. And so that's what most people would guess. So as always, your intuition is probably not going to be correct. Just kind of hold that thought. Let's go find out more about which of these has more leverage. So the topic for today, related topic, is it safer to sell naked index options? So the reason I came up with this topic is I hear this a lot. People like to get on these programs of just consistent selling options. They think it's free money. And what I hear a lot is they'll say, well, I don't want to sell options on AMD or NVIDIA because those are really volatile tech stocks. Let me do something safe like the SPX or the SPY or the QQQs and just do some out of the money options. And the reason they say that is because they have lower volatility. And what we want to show here, that's not necessarily correct. There's another aspect to volatility that we have to consider. So we're going to, at least for right now, slant it from all of you who like to sell naked options. We never advocate that here at Market Rebellion. It is just for the learning experience. So if somebody comes out and says, I want to sell these naked options, which remember means they're not covered. That's just the outright sale of a call or a put. And we're going to take unlimited risk in one direction or the other. Is it really safer to use an index option?
I feel the need for speed. No, I'm kidding. I feel the need to step in here for a second.
Sure.
And just say one thing about selling options. I as a teacher, coach, trader, I don't really have any issue with selling options. In fact, I love selling options. It kind of makes my day. I sleep better at night selling options, believe it or not. However, and I would never say to anybody, that's a bad idea, don't sell options. What you want to do as a trader, as a focuser, is that a word, Bill? Focuser?
We can make it up here.
As a focuser of a person that focuses on risk is to quantify a potential loss. So
yes.
While you may want to go ahead and sell an option because you think it's fat and juicy and you want to take the money in because you think it's going to go to zero or close to zero, I, as a coach and a teacher and a trader, have absolutely zero problem with that. The thing that I need to advocate is that you need to consider buying something somewhere to be able to quantify your loss if, in fact, it does happen.
In case you're wrong.
You can now come up with a number where you can say, yeah, I can live with that.
Yep.
And that's a subjective thing. You know, I'm never going to say, you know, it's all like, it's about risk tolerance. It's not about selling the option or not selling the option. It's about how much risk are you willing to take as described by the dollars that you may lose. So as long as you're willing to quantify that and live with that number, go for it. Have a great time. I do it. I mean, you know, I'm not going to put myself in harm's way to blow up and say, oh my God, you know, what did I do?
Right.
I'm going to put myself in harm's way to say, this is how much, if things blow up on me, what am I willing to lose if they do blow up? Not that I'm planning on it blowing up, not that I would ever enter a trade where I was planning on losing. But as we all know, things happen.
Yes, they do.
They happen at the times when you least expect it. So it's always a good idea to just CYA in the event that something does happen. So at least you know ahead of time what you could be in for.
Yeah. Now, also, we can also spin this in a different direction. What about the buyer? If we want to look at more of the non-risk or the less risky side as the buyer, and say, is it better to buy the NVIDIAs and the AMDs because you're going to get more leverage? So we can spin it either way.
Yeah, you could.
So the big question is, which one of these has more leverage? And that's what we're going to find out when I say which one of these, talking about indexes versus individual names and tickers. Let's start off with a little background about leverage, just in case somebody is not familiar with that. Financial leverage is just simply a magnification in returns. So let's say that the stock rises 10%. If you have some type of an asset, or let's say even shares of stock on margin, and you're getting 2-to-1 leverage, well, that's now going to go up 20%. It's going to go up 2 times the change in the stock. If you have 3-to-1 leverage, it would be 30 times. All right. But however, remember, leverage is a double-edged sword, which means if the stock goes down 10%, here you would lose 20%. So this is always the biggest risk when you are writing options. Little side note too, Stu, remember Bear Stearns? With the collapse during 07-08 financial crisis in the movie The Big Short, they're known to do leverage of 200 to 1.
200 to 1, yeah.
They were highly, highly levered, and that's what can happen when markets go against you.
Yeah,
so again, what we're trying to figure out is which of these are going to provide more leverage.
By the way, Meta's earnings are out. The stock appears to be up around $45 on a straddle that came out at 24.
Wow.
Unbelievable. Trading
let's see if it holds. Let's see if it holds. Interesting.
Yeah. Yeah. Kind of leads me into a whole nother discussion, which we're not going to talk about now, which is if I had the call and this happened, what would I do?
Oh, well, we should do that. Let's do that. So maybe we could even do it next week as a coach's corner. All right. That's a very good dilemma that people have. They'll go, let me wait for the opening bell.
Yeah.
Opening bell comes and now the stock is back to unchanged.
Back to unchanged or down or worse. $10 or something. You know, it's like, what's the intrinsic value of that 395, which is the at the money call? What's the intrinsic value of that now? Well, I don't know. It's at the money. So nothing. But, guess what? The stock's trading for 40. So I'm pretty certain it has $45 worth of intrinsic value. You just can't see it because the store's not
way we can yank that out of there. All right, so let's go back. Let's start off with our indexes. So remember, it's not just the SPX, but I'm going to use that as my example. But indexes are made up of many different stocks. They're just a big basket, like a mutual fund. So we have SPX, SPY is a 1/10 version. We have QQQs, NASDAQ 100. There's the Russell. There's all kinds of indexes, but they're a basket of stocks. And one thing that traders look at is they'll say, well, all right, but it's harder for a basket of stocks or an index to move a certain percentage than for an individual stock. Because you've got this, and that is true because you've got this big basket of stocks. You might have one of those guys in there. In fact, let's say for the S&P, you've got Meta, but it's not going to make the S&P move that much because there's going to be a lot of stocks that are down or unchanged. But because of this, traders think that the indexes are safer. Now, again, if you're not thinking about it from the writing perspective, what about the buying perspective? A lot of traders say, I don't want to mess with the indexes. There's no money in it. They're low volatility.
The weighting on Meta in the S&P is 2.15%.
Yeah. So it's not going to have really not much of an influence at all. So let's take a look at this now. Let's dive a little deeper into this whole concept of the leverage. So the SPX, remember, 4890. Now, part of the reason that I chose the SPX most of the time in the presentations, I'm doing the SPY, 1/10 index. But part of what I'm trying to show you here with the leverage is it depends on the base. How big is the value of the asset that we're comparing? And the SPX, being the bigger contract, has almost a $5,000 base. And this is something we have to consider. Now, AMD at the time was about 170. So the first question we want to explore, which of these options are more expensive and which have more leverage?
And just the fact that AMD is 170 is just unbelievable. But again, that's another topic.
A whole other topic.
Sorry.
And then how quickly it got there. So we want all of our viewers to just take a quick moment. If you were presented with these and you're looking for some good leverage, and we have to, of course, keep everything else the same. We think that they're both going to have certain percentage increases. Which is going to give you the best leverage? All right. And then which one would you say is going to be more expensive? Which will have the more expensive options? All right. Well, take your answer there. Let's go ahead and check to see if you're correct. And before we do, please visit us at marketrebellion.com/get started for anybody who is brand new or maybe even experienced with options. We have a lot of great articles and videos to help you get started with more topics like these. And we think that you'll find those helpful. Mm-hmm. So let's start out by comparing two at-the-money options. We've got the SPX 90-day 48.90 at-the-money call trading for 145. We have the AMD 90-day 170 call trading for 15. Now, again, remember, for those of you who might be following along going, hey, there's no 90-day option, I had to use a pricing model to kind of figure out where it would be trading. But that, you could be rest assured, would be very, very close if there were a 90-day option. First question, which is cheapest? Second question, which has more leverage? All right, so these are the two that we're going to compare. Let's start and give you a little different perspective on cost. One of the things you should do as a trader is consider options as a percentage of the underlying for a cost. So for instance, let's say if we have, I don't know how those got backwards. Sorry about that. If we have the SPX, the 48.90 call is trading for 145, and the AMD 90 170 call again is 15. Let's take 145 cost of the option divided by the base 48.90. It's about 3%.
3%. Yep. You're
paying 3%. See, the illusion is here, you're talking about a very big base. So it looks like $145 is expensive, but we have to remember it's almost a $5,000 asset. So it's only 3%. Now let's take a look at AMD. It's a $15 option on 170 base. Remember, it's at the money. That's where the stock was trading as well. It's about 9%. So in relative terms, AMD is about 3 times the cost of SPX, whereas most people would
ask yourself, people, which one's cheaper?
Right. How did you answer? Right.
We have this discussion all the time. You know, which one is actually more expensive, or which one is actually cheaper? Mm-hmm. One's 15, one's 45. But well, 9 out of 10 people, or maybe 10 out of 10, I don't know, some high numbers.
Wow, that's almost 10 times higher, right? They'll say the SPX is way more expensive. But what they fail to compare it to is that it's also a much more valuable asset.
It's always relative. Always.
It's one of the big points we try to make to people, right? All right, so that's one thing that's probably already right off the bat giving you a different perspective on cost. Let's do a similar thing with leverage. And I find this to be a little more surprising. So here's our options again. Let's say that the index rises 10%. On a base of 4,890 would be 489 points.
Yep.
Now, it's an at-the-money option, so we're going to assume that we're at expiration. What's that thing worth at expiration? 489. Right? You got 489 points of intrinsic value.
Let's take a second and review that. So what happened at expiration? All the time went away. The option is now in the money. We know what the price of the stock is because we've already defined it of an index rise of 10%. So it's 408. We started at 48.90. 10% is 489. We know what the ending number of the stock price is, or the index price, I should say. Mm-hmm. So we can now back out the price of the intrinsic value. And that's how we know what the price of that option is. And that is a very, very valuable lesson in and of itself right there, because I could tell you most people, when I say to them, well, when the stock goes to, and I'll name some number, when the stock goes up 10%, how much is the option going to be? Or when the stock goes, when the $100 stock goes to 108 in 2 weeks, how much is it going to be when it's expiring? It's like, I used to have a boss. I don't know. I don't know. Well, the answer is you do know. Because if you got the concept of intrinsic value and extrinsic value down, and you know that extrinsic value is going to go away, the only thing that can be left is intrinsic value. And if it's out of the money, it's going to be zero. And if it's in the money, it's how much is it in the money? And that's your intrinsic value. So that's how we came up with that number. So anyway,
exactly. So we know that it's going that option is going to be worth 489. And the question is, how big is 489 relative to the 145 price that we paid?
Looks like
That's
about
3.37 times.
Okay,
of course, we have to subtract off the base, so it's 237%. That's a 237% increase in that option's price.
Yeah.
Now, let's do the same thing with AMD.
Yeah.
Got the 170 call trading for 15. Stock rises 10%, which is how much? $17. We know that option would be trading for 17. You paid 15. You're up 13%.
Boom.
Ooh, look at that. 237% on the SPX and only 13% on the AMD.
Yeah, but look, AMD is a single stock, and we've already talked about this. 10% is 10%. What's the chances of the SPX doing the individual stock movement? I mean, isn't that the whole idea behind?
And that is a great point. Exactly. You have to say that the volatility in AMD is a whole. Where is that anyway these days, Stu? 30 something percent, 35.
30,
where is it?
42,
41 or 42. Well, that's a whole lot different than 20%. It's a solid double on top of it. So it's far more likely to move 10%. But the point that we're trying to show is that it's not necessarily an easy comparison to just do a slam dunk blanket statement. Don't do the indexes because you'll never make any money. Whether you're taking the long side or if you think that you can make some free, easy money by taking the short side. There is a lot of leverage in there, a lot more than people recognize. Yep, so that's actually a good point. If you had to guess which one is more likely to move 10%, you would probably pick AMD. However, to take the counter argument of the counter argument, what about during COVID? What if you were on one of these selling sprees and you get caught, or 07, 08, and it just absolutely melts down 50% in front of you?
Or you're caught in a meta, it's up $40 or $45 when the pricing was priced at about $20. I mean, this is what happens.
Yep.
And it's you got to take into account the volatility. And when I was saying before to Bill about 10% versus 10%, is that realistic? Well, the real answer is no. But that's why the index options are have an implied volatility considerably lower than an AMD. I mean, that's it's supposed to balance out in the real world.
Yep. But you could also say one of the things that we like to show in our Q&A is, especially for the newer traders, long-term or longer term, at least, viewpoints. And so if you're going to take 9 months or a year or 2 years, and you're going to do an index option just because you're not comfortable picking stocks, you do get phenomenal leverage off of your indexes, or you can. Yeah. So if you give them time to move 10%, you can absolutely make some money.
Yeah, look at that, man. That's huge.
A lot bigger than people would expect. So that was really kind of the main point of the presentation. So as always, quick reminder, please visit us, marketrebellion.com/get started. Tremendous amount of free videos and articles. I don't even think you need to sign in or do an email, Stu. I think it's just sitting right there on the website. But jump in there and check it out. You get a lot of great free training materials. It's so important, not in which stocks you buy or what you think of whether the market's going up or down. Remember, the market doesn't care what you think. It's, do you understand how the options are going to respond to what you think is going to happen? And that's where a big part of trading, we find that people just don't understand that. So let's take a look at the graphically of the SPX and of AMD here. So along the horizontal, now in our example, I just did a 10% increase, but we're going to do 5%, 10, 15, 20, and so on. And then the blue line is showing the percentage change in the option for SPX. The black line is showing the percentage change for the option in AMD. So take a look at that. Look at how much steeper that blue line is. Again, that would shock a lot of people.
Yeah, you'd think it was really the other way around.
You would absolutely think it's the other way around. Now, also take a look. This black line is underwater. Looks like right around up till 10%. And that's kind of what we figured. It'd be about 9% would be the break even. You would need AMD to move 10%, 9%, just to get your money back. But if the SPX moved 9%, well, that's pretty close to the 10% we were talking about. Look at this. That's already a 200% gainer right there. So once again, part of the idea to take away from this presentation, especially if you're new and you're saying, I don't really know much about stocks. I don't know which ones I should buy. Let me go visit some of these chat boards, or let me go look at some YouTube videos. You don't need to do that. Get the diversification, do the SPX, give yourself longer term viewpoints, and you can get tremendous, tremendous leverage from the indexes.
So, Bill, I'm going to play devil's advocate for a second here.
Sure.
So, yeah, Bill, but I can get if I make 10% on average in the SPX or SPY, why wouldn't I want to buy Amazon, and I'm going to make up a number here, and make 39% over time, or some thousand or hundreds of numbers of percent here? What's to stop me from doing that? I mean, I'll probably even make more money. In fact, I will make more money by owning a winner versus owning the index.
Yeah, so, and you're exactly right. The problem is number of issues there. First of all, just because you think in your example there Amazon is going up doesn't mean that it will. All right, so that's one thing, is you're taking a big chance there, whereas in the S&P 500, it's diversified. So if any one of those 500 or so stocks in there happens to have a bad day or a bad year, you've got others to hold you up and prop you up. And that's not true. And if you're in Amazon, that's all you have is Amazon. It's either sink or swim, right? That's all you're going to get. Now, the other issue is that it might look like you made more money if you make 40% by trading Amazon as opposed to making 10% on the SPY. That's also a little bit of an illusion, because to make things fair, we would have to compare it on what's called a risk-adjusted basis. How much risk did you take?
Yeah.
If I make 10% on the S&P 500 and you make 15% with your strategy, it looks like you did greater. Looks like you did, super. You beat me by 50%. But then people ask you, how did you do it? And you say, I took all of their money and just bought a bunch of lottery tickets. So that's an extreme example where people should say, hey, wait a minute. That's not really a good return.
Yeah, it's like my buddy the other day said with the real estate, the perfect world, I would just sell the house and put the money in the market. It's like money in the bank. The part, like what Bill's saying here, I think, Bill, is that the money that you put into the Amazon stock or the XYZ stock, whatever it is, people don't think about the risk that they're taking.
Lots of risk
when they do that. That risk may pay off and it may not pay off. And that piece of the puzzle is often, how can I say it?
It's completely ignored. People think a stock is a stock.
Yeah, it's just ignored. Where in the index, you can ignore it, but it's there for you. It's already done. The work is there for you. Right. It's more of a gradual over time compounding effect.
Absolutely. Yep.
And that's not to say we shouldn't own individual stocks. There's nothing wrong with that.
Nothing at all.
But you got to own individual stocks. And I sound like a broker here, and I don't mean to be the RIA here. It's just if you're going to own individual stocks, just understand that the individual stocks carry with it a different profile of risk than an index does.
Not only from the individual stock, but also the lack of diversification. That's such a big benefit. Maybe we should even do that again, revisit it for a coach's corner, and just show the real true reason behind diversification and the real benefits of it. But for right now, we just really wanted to kind of open your eyes to this idea of looking at cost from a different perspective, look at it relative to the base or to the value of that asset, or in this case, the index, and then also on leverage. So for any given percentage change move, 5, 10%, whatever, most of the time, these, especially if it's got a large base like the SPX, is going to give you a bigger return, or at least far more leverage.
Yeah,
And that's something that people
you
just
absolutely have to look
overlook.
at that, and you have to look at the pricing level.
Absolutely.
So yeah, Meta trading 445, unbelievable, up 30,
Still holding.
40,
That's
50,
the thing that always gets me.
$50.
Sometimes it'll spike on the news and 5 minutes later it's down, but it's still holding, huh?
It's holding and climbing. It's actually moved 2 standard deviations. Unbelievable.
Crazy.
Amazon is up 10.
Yeah. Yeah.
They
So
had
you can-
earnings. They were initially up 5. Looks like another 5 on the piggyback in Meta, and we're still waiting on Apple.
Nice.
Apple's coming out. They're looking a little bit light here. The stock's actually going down just a touch. Now it's back up. So we'll see. Okay. Cool.
So the main takeaway for everyone, consider SPX or QQQ as underlyings, especially if you go, I don't know what to trade. I'm not going to be a good investor because I don't know how to pick stocks. You don't need to know. And so not only do you get the leverage and the cheaper cost in terms of percentages, but you also get this benefit of diversification. But again, you get far more leverage in most cases than most people would anticipate. So that's the basic idea. If you have a very large base like with the SPX, don't underestimate the leverage that you're dealing with. So for everyone who likes to go and sell way out of the money SPX options because they think it's free money, hopefully this presentation will give you a different perspective. So let's come back to our chalk talk. Stu, what do you think the answer is here?
Let's see here. SPX.
I'm going SPX.
Look, man, go back, Bill, maybe just look at the option price. $15
on 170.
170. Just do the math. $15. We did it before, right? Didn't we? $15.
And remember, that's all extrinsic value.
It's
all air.
Yeah, it's all air. And the 145 on the $5,000, it's so much less.
It's less. You got to consider that.
This concept is prevalent in so many different cases. It's like, do I want to buy the 30-day option or do I want to buy the 90-day option? Do I want to buy the 1-year option?
Oh, yeah. Good example.
12 times over the course of a year and have a 1-year option. But which one's going to be cheaper in the long run if I'm actually
Everybody looks at the absolute cost. They say the 1-week options are cheaper. They don't look at it per unit of time.
Yeah, right. It's the same idea here.
Exactly. So again, we hope that gives you a different insight. That's always our goal here on Coach's Corner.
Yeah.
And Stu, I think we need to do one of those for next week. I think we'll have to talk about those. We'll figure it out afterwards. But let's do. We'll be kind of an offshoot of this for next week. But we hope that if you're new, it's great having you here. Please bring your friends. We're really trying to grow this channel. And Stu, any closing comments?
Yeah, let's go back to my initial question. If you own a Meta straddle call option right now, what would you do? What would you do?
A straddle or a call?
Either one.
Okay.
Either one. If you own the call.
Oh, I see what you're saying. Oh, because now that the stock is up.
Now the stock's, now the stock is $450.
You know what? Let's do that one. We'll make a decision right now. Let's do that one. We'll throw that question out for everyone. Let's say that you're holding a call option. We'll keep it simple. You're holding a call option. Meta's up 45 points. And you're thinking, hey, on the opening bell, I'm going to be able to close this for about $45 of intrinsic value, except that when the opening bell rings, it's now down 5 points. Well, and there's no option. The options market's not open right now. How could you close that position? There is something you can do to lock that.
Are you telling me that can happen?
Absolutely. Anybody who's been trading for any length of time has seen that happen on earnings. It wouldn't even surprise me if we see that Meta's not up the same amount by tomorrow morning.
We'll see. And just to give you a little perspective, the call option is about the at the money call option was $12.
Okay.
Stock $3.95, and the at the money call option is $12.
Beautiful.
Tomorrow, what's today? Thursday. Tomorrow's expiration. Let's call it expiration. And now what? Be the trader. Be the person. Be the trader you want to be. What would you do?
Yeah. So think about that one for the week. We'll come back and we'll actually do that next week. How would you lock in that cash if you were in this meta trade. So with that, I want to thank everybody for being here. I hope you learned something great. Have a great weekend, and we will look for you next Thursday on Coach's Corner.
See ya.